So how exactly do cooperatives fund fresh ideas, tackle special projects, and modernize their operations legally without running afoul of those famously strict accounting rules? Well, it's a super common hurdle, but there's actually a specific mechanism built right into your accounting that's designed to solve exactly this problem.
Welcome to this explainer. Today, we're going to take what might look like a totally dry, boring accounting rule and transform it into your cooperative's absolute most powerful strategic tool for growth. We're talking about the optional fund. We're going to break down the exact journal entries, the compliance rules you absolutely need to know, and how you can actually leverage this thing in the real world. To really get a grip on the optional fund, we're going to walk through 6 quick steps. First, the basics, then purpose and application, the accounting rules life cycle, financial statements, reprogramming and pitfalls, and finally, fueling cooperative growth. Let's jump right in.
Starting off with Section 1, the basics of the optional fund.
Okay, so by definition, the optional fund is a discretionary appropriation of your net surplus. What does that actually mean for us? Basically, it's money set aside by the co-op for very specific purposes that aren't already covered by your standard mandatory funds, like the General Reserve or the Education and Training Fund. It gives your cooperative this ultimate flexibility to address strategic needs, drive innovation, or even build up contingencies, all driven by your own bylaws and, of course, the General Assembly's approval. Now, when you're carving up your net surplus at the end of the year, you have those mandatory slices of the pie, right? Like the minimum for the reserve fund. But, and this is a big but, RA 9520 dictates a really strict legal boundary for the optional fund. It literally cannot exceed 7% of your net surplus. That's a hard cap you absolutely must stick to during your allocations.
Moving on to Section 2, purpose and practical application. Why even bother using this fund?
The absolutely crucial point here is that unlike those mandatory funds, they kind of just sit there gathering dust until a specific legal trigger happens. The optional fund is completely purpose-driven. You set it up to actually use it. It's designed specifically to finance special projects, support your modernization efforts, provide some stabilization or contingency support, and fund awesome member-focused benefits that align with your policies.
To really picture this, imagine a digitalization initiative. Let's say your co-op is stuck in the dark ages using outdated spreadsheets and you desperately want to modernize. Well, you can use the optional fund to purchase shiny new accounting software. The ripple effect? You get vastly improved efficiency and transparency. And the best part is, it's all funded without completely derailing your normal day-to-day operating budget.
All right, Section 3, the accounting rules life cycle. Let's track how this actually flows in the books.
The life cycle kicks off at birth, essentially, with an appropriation entry. When you allocate from the net surplus, boom, you've created the optional fund. To do this on the accounting side, you record a debit to the undivided net surplus, which shrinks your general surplus pool, and then you record a credit to the optional fund. That establishes this brand new, dedicated equity balance.
Hold on though, before a single peso is actually spent, Step 2 demands some really strict compliance. The optional fund has to be tightly tied to a clearly defined purpose or project. You've got to follow your cooperative's bylaws to the letter, and most importantly, you absolutely must secure General Assembly approval. It is highly, highly regulated internally.
Then we hit Step 3, when expenses are actually incurred. So when you finally go out and buy that new software we talked about, you first record it just like a normal expense. You debit your project expense account and you credit cash, simply because the money is leaving the co-op's bank account.
And here's the magic trick in Step 4, closing against the optional fund. You really don't want that big project expense to hit your general operations and ruin your bottom line, right? So to fix that, you debit the optional fund and credit the project expense. The expense is neatly absorbed and your optional fund balance just decreases accordingly.
Okay, let's ground all those debits and credits with a super practical math example. Let's say your cooperative has a total net surplus of 100,000 pesos. You decide to allocate an optional fund of 5,000 pesos. Sometime later, your approved modernization project ends up costing you 3,000 pesos. After you run through those exact accounting entries we just walked through, your remaining optional fund sits comfortably at a balance of 2,000 pesos, totally ready for the next phase of the project.
On to Section 4, financial statement presentation. Where does all this actually live on your reports?
Well, getting the presentation right is absolutely vital. The optional fund itself firmly belongs in the equity section of your balance sheet. Remember, it's an appropriation of surplus. So yeah, it's equity. However, the related expenses, when you actually go and spend the money, those must initially reflect in your statement of operations. They pass through there first before being closed out against the equity fund. Transparency is the name of the game here.
Section 5. Reprogramming and common pitfalls. Let's talk about staying compliant.
Look, we all know plans change. A project might get canceled, or hey, maybe it comes in way under budget. The really good news here is that the optional fund can actually be reprogrammed. You can reallocate it to another valid purpose, or you can even return it entirely to the undivided net surplus. But listen carefully to this. Doing so absolutely requires formal approval. You definitely cannot just shuffle this money around on a whim.
Because this fund offers so much flexibility, auditors watch it like a hawk. So please avoid these common pitfalls. Never, ever use the fund without a strictly defined purpose or explicit General Assembly approval. Do not try to bypass the expense closing process by treating it directly as an operating expense. And literally never proceed without meticulous documentation. Doing any of that is basically a guaranteed way to fail an audit. Finally, Section 6, Fueling Cooperative Growth. Let's look at the bigger strategic picture. The ultimate takeaway from all this is really one of strategy. While your mandatory funds are there to play defense, ensuring compliance, safety, and stability, a well-managed optional fund is your offense. It's your engine for progress. It's what enables growth, innovation, and agility. A genuinely smart cooperative uses this fund proactively to anticipate future challenges, to seize unexpected market opportunities, and ultimately to massively enhance the long-term value it provides to all of its members.
So, I want to leave you with this final thought. Now that you're armed with the exact limits, the core accounting entries, and an understanding of the incredible flexibility of this tool, what game-changing innovation is your cooperative going to fund next?